When setting up your business, how do you pick the right tax structure so that your goals are achieved? Meaning like setting up your business as an LLC only to come to find out during tax time that you're going to be responsible for the tax bill. Not what you were trying to do? Then let's talk about how to make sure that your tax goals are met when setting up a business. Welcome back to another episode of Minding My Money Mondays, the place where we help individuals and small businesses make my money make sense. So in part one of our series, we talked about the organizational structure. You know, how business entities are legally structured. In part two, we discussed how to legally set up your business structure, what forms to fill out, where to send them, etc. Now in our final video, part three, we're going to talk about how to set your business up from a tax perspective. So the first place to start is by asking yourself, who do you want to be responsible for the business's tax bill? And this is important because depending on the answer, you might not want to legally set your business up a certain way. Difference between legal and tax structures. As we briefly discussed in part one, a legal structure is not a tax structure. A legal structure is set up with the state or through a legal agreement. A tax structure is how the IRS is going to tax an entity. So let me give you an example. Two people decide that they want to go into business together. They talk to an attorney and they draft up an agreement. Basically, they've created a partnership. Now, this agreement will not typically be filed with the state in most cases, but it is a legally binding document. So, how is this business going to be taxed? Well, the IRS says that since they don't have a state-formed corporate entity and it's two people, they're a partnership. So they'll be taxed that way, and their entity will have to file IRS Form 1065 or a partnership tax return. Now, here's what's important. This type of entity does not pay taxes at the federal level. Nope. It passes the liability on to the partners, and they pay the taxes on their income tax returns. Business types where owners pay the taxes. So back in part one, we discussed in depth how the various entities are taxed, meaning the sole proprietor or single member LLC file on Schedule C of Form 1040, multi-member LLCs or partnerships file IRS Form 1065, and S-Corps file IRS Form 1120-S. So we're not really going to rehash all of that right here. Instead, what we want to highlight is that all of these entities are pass-through when it comes to taxes, meaning the owner is the one that pays the taxes of the business. So if you don't want to be responsible for the taxes of your business, then you might want to consider forming a corporation. Business types where the business pays the taxes. So a corporation is legally set up with the state, and from a tax perspective, is considered separate from the business owners, meaning it's responsible for its own taxes. And this is important because not everyone pays attention to this until it's potentially too late. For example, someone says, I want to start a business, but I want it to be a corporation. They talk to an advisor and they suggest that they set up a limited liability corporation or LLC. Now, is this a corporation? Yes, it is. It even says so in the name, and it's legally formed with the state. But will it be taxed as a corporation? By default, not according to the IRS. If it's a single member LLC, then it's going to default to being a disregarded entity and taxed on Schedule C of the owner's tax return. If it's a multi-member LLC, then it'll default to filing its taxes as a partnership, and the owners will still pay the taxes on their tax return. So the only way to keep the taxes separate from the owners, either one, change the tax classification with the IRS by filing IRS Form 8832, or two, set up the business as a C corporation that will file its taxes on IRS Form 1120. Our free download for you. Launching your business is going to take everything that you've got to make it a success. So to help you out, we created a free download for you. 10 accounting and tax tips for startups and small businesses. To grab your copy, just click on the link in the description of this video, or you can click right here. We'll then shoot that over to you, as well as let you know when our new course, How to Set Your Business Up from a Legal and Tax Perspective, a Step-by-Step Guide, is ready and available for purchase. What entities pay the most and least in taxes? So the answer to that question is, it depends. So let's look at some hypothetical scenarios to help you get an idea. Let's say that you have a business and it does $100K in profit. If we put that business into the various structures and keep things simple for illustrative purposes, we will see that electing to have the business taxed as an S-Corp will probably produce the smallest tax bill. Now, we're oversimplifying this example by assuming that the owner is single, that they have no other sources of income, they take the standard deduction, and they qualify for the QBI deduction. The next lowest tax bill will probably be the C Corp, and then the worst options would be the sole proprietorship, single member LLC, multi-member LLC, and partnership. And this is primarily due to the cost of self-employment taxes. Now, what happens if the business does $150,000 in profit? Things pretty much stay the same. The only thing that happens is that the magnitude of the tax savings by choosing the S Corp over all the other pass-through structures increases, and the C Corp, it keeps on holding on to the second position. Now, once the business gets to a certain point, the S Corp technically would not be the best structure. And that's because under the current tax law, a C Corp is taxed at a flat 21% tax rate, while all the other pass-through entities are taxed at the owner's tax rate. With the highest personal tax rate currently being 37% under the current law, at some point it just would make more sense to be a C Corp if the primary goal was to have the lowest tax bill possible. So how do you choose? So as you can see from this video, picking the right tax structure can be hard. You have to not only know how you want the taxes to flow, but you have to also know things like the business's size, its profitability, current tax rates, and the like. So our advice: use the things that you learned in this video as a guide, but if you still can't decide, then get our free download so that you know when we release our course, and that might help you out. Or you can reach out to a tax professional and get a consult. We'd be happy to help you make the decision that's best for you, so feel free to reach out for us using the contact information that's in the description of this video. Now, if you like this video and you got some value from it, then please give it a thumbs up, or you can say thanks by buying me a coffee. The link's in the description of this video, and the extra coins go towards helping us make future videos and pay for things like gear and props. So until we meet again, let's all remember to mind my money, and I will see you all next Monday. Take care.